today. I am once again stuck in the middle of a tax debate between Julie and Brian, and coming at the tax conversation, both on the capital gains side and the corporate side. And I guess when I started writing this piece, I thought it was going to go one way, ended up going another, as often happens. So really went in on the capital gains rate and the impact it does, but ultimately does not have on investment flows. So Goldman Sachs, favorite firm here at Yahoo Finance, they found that 1%, basically 1% of money high net worth households had allocated to stocks came out of the market ahead of the 2013 capital gains tax increase. But then an equivalent of 4% of that sector of the market's holdings came back into the market in the quarters following the capital gains hike, indicating, Sozzi, that higher capital gains taxes were not a long-term deterrent in investing in stocks. And my argument here is that investing in stocks is a relative judgment on other assets, on cash, on real estate, on bonds. And so though you may face a higher future tax burden on your equity investments, if investors deem, as they have in the past, and Goldman expects they will in the future, deem stocks to be a better alternative than other allocations for their capital, then the bid for stocks will remain, whether you are taxed at the 15% cap gains rate, 20%, or some higher number, as has been proposed by the Biden administration.
Now, Myles, I like how you continue to play moderator in this raging debate between Julie and myself on taxes, but I think you make a very good point in the morning brief newsletter. It's all relative. So if you were concerned about higher capital gains taxes, what are you going to do? Sell all of your stocks and go buy some illiquid real estate? No, that's probably not going to be the case.
Well, and I think this comes back to the idea, too, that taxes don't exist in a vacuum, right? And this is a little bit similar to the argument that, oh, the tax rate is so high in New York and New Jersey, you have this exodus of people to Texas and Florida. I got news for folks. People are not just moving to Texas and Florida because of the higher tax rate. I mean, where you make your decision where to live has a lot more, has a lot of different factors besides just the tax rate. So I think that is similar to what we're talking about when you're making investment decisions. A lot goes into it besides just the tax rate, including what your return is going to be. That's probably the biggest decision, right? And on a relative basis, if you decide you can make more in stocks, you're still going to put your money in stocks.
Yeah, and back to the relativity point. And again, when I started writing this piece, I actually wanted to go at it this way. So maybe it's easier to talk about things than it is to write about them. But I was looking at it from the corporate side, right? Which is that the corporate tax rate changes for all corporates. Obviously, some sectors are more exposed to tax changes, or tax rates, I should say, than other sectors are. But the absolute rate changes for all corporates equally. And so the relative tax burden faced by any one sector versus any other does not change. And so from a corporate standpoint and from a style standpoint, you are not likely, maybe around the margins, and again, things can get very granular when it comes to quant strategies, and I expect they will. But if we look at the highest level of I am X% allocated to consumer discretionary and X% allocated to communication services, higher tax burdens for the corporate sector is not likely, now doesn't mean it won't happen, but is not likely to change an investor's preference for consumer discretionary versus communication services, and is also not likely to change the relative both realized and expected performance from consumer discretionary versus communication services as a result of facing a higher uniform tax burden. Again, the number that those businesses in those sectors tend to pay will be different, but relative to one another, the spread will not change, and thus the allocation decision, which is really what this conversation is about. But the idea is that higher taxes are going to force people to move out of the country was what I've seen suggested on some other places, which is not going to happen, or just shy away from equities wholesale. That stuff does not necessarily happen because the relative attractiveness of these investments changes, does not change, I should say, right? They're benchmarked to one another. And so again, this is getting into like CFA, I guess this is level 3 portfolio construction type preferences. And I know that we're going to have tax experts on here who are going to tell us it's not that simple. And I'm not saying it is simple, but investment decisions are based on how you can earn the best risk-adjusted returns over time. And the tax rate does not necessarily and does not uniformly and does not clearly change the relative attractiveness of some assets versus another. Does not mean it doesn't matter, just means that it is not the one-stop shop bad or good judgment that I think often tends to happen. And so while I am typically not the moderate person in general on this issue, I do enjoy my physically middled position against both of you on either side of this. And I look forward to future explorations of corporate taxes and all the other good fun in the economy as we move through this period.